This week marks a major moment for XRP as the new 21 share spot XRP ETF prepares to go live. Many investors are wondering what this launch will mean, how much XRP these funds will absorb, and how this will impact the market as more institutions gain access to regulated XRP products. With this new addition, the market now has 5 separate spot XRP ETFs competing at the same time, creating one of the most intense environments XRP has ever experienced. Alongside this, Ripple has revealed new updates on the XRP ledger, Japan's carry trade is beginning to unwind, and on-chain data shows XRP exchange supply tightening at record speed. There is a lot happening, so let's go through everything step by step. According to analysts, next week will be the first full week where all 5 spot XRP ETFs operate together, giving us the clearest picture yet of how much XRP institutional funds will need every single day. Early calculations show a baseline demand of nearly 75 million XRP per day. Meanwhile, exchange supply has thinned to roughly 2.7 billion XRP, while 300 million from escrow re-enters the market every 30 days. Using elasticity models between 0.02 and 0.05 over a period of 180 days, analysts warn that lower elasticity could drain exchange supply quickly, while higher elasticity could trigger fast, aggressive price spikes. Meanwhile, OTC desks are already absorbing liquidity quietly in the background. The new 21 shares XRP ETF will trade on the CBOE BZX exchange under the ticker XR. It is a physically backed ETF, meaning it holds real XRP, not derivatives. It will track the CME CF XRP USD reference rate and operate with traditional creation and redemption mechanisms using Anchorage and BitGo for custody with a management fee of around 0.5%. While 21 shares already operates an XRP ETP in Europe with a much higher fee structure, this new ETF is specifically designed for US institutions that prefer SEC-registered American-listed assets. As it launches, it joins major players like Grayscale and Franklin Templeton, which have already attracted nearly $700 million in inflows in less than a month. With all 5 ETFs trading simultaneously for the first time, the market will get a clear picture of real daily XRP demand. On-chain data shows that nearly 29% of XRP previously sitting on centralized exchanges has already left in recent weeks. This outflow aligns perfectly with ETF approvals and indicates a tightening supply environment even before the newest ETF begins operations. If OTC desks eventually exhaust their private reserves and must refill by purchasing from the open market, the price impact could be explosive. A consistent daily demand of 50 to 100 million XRP would cut through exchange order books with ease, wiping out sell walls and creating the conditions necessary for rapid price acceleration. Ripple's influence continues to grow as its new US dollar-denominated stablecoin, RLUSD, surpasses $1 billion in market cap on Ethereum. This represents nearly 40% growth within a single month, making it one of the fastest expanding stablecoins in the industry. Ripple executives emphasize that this momentum is only the beginning. According to RippleX head of product Jassy Cooper, Ripple intends to bring more real-world financial volume onto the XRP ledger by improving compliance tools and expanding the infrastructure for decentralized finance. She notes that DeFi should not be seen only as speculative trading, but as a complete rebuild of financial systems on blockchain rails, with stablecoin payments and cross-border settlements becoming primary use cases on XRP ledger. As attention grows, self-custody solutions like the Descent biometric wallet and Zum wallet experience record demand. Descent is offering one of its largest discounts of the year, and thousands of users have already upgraded their security. These wallets support thousands of cryptocurrencies, including XRP, and offer features such as fingerprint technology, native DApps, market insights, and cross-chain swaps. As self-custody becomes more important in a tightening liquidity environment, many users are transitioning away from keeping crypto on exchanges. Within the XRP community, some confusion has surfaced regarding whether private and public XRP ledgers could lead to 2 different XRP prices. Experts clarify that this is impossible. Both private and public versions of the XRP ledger ultimately rely on the same XRP when used for settlement. Because assets can move between these networks through bridges or custodial mechanisms, arbitrage ensures a single global price. The only way a different price could exist is through a separate wrapped token or internal instrument that is not actual XRP. Therefore, no matter how private ledgers function, Institutions requiring liquidity will always need XRP from the open market, and public holders share the same pricing environment. Side chains on the XRP ledger use the XLS38 model, where XRP is locked on the mainnet and issued as wrapped XRP on the side chain. When wrapped XRP is burned, the original XRP unlocks. This means total supply always remains anchored to the main ledger, and any ecosystem growth requires more XRP to be locked away. As more institutions adopt private or sidechain deployments, they will need increasing amounts of XRP, tightening supply further, and amplifying price pressure on the main market. Ripple's engineering teams continue moving toward full EVM-compatible sidechains, which have been tested for years and are now approaching mainnet readiness. Meanwhile, global financial shifts are accelerating. Japan's famous carry trade, which allows traders to borrow Japanese yen at extremely low interest rates and invest in higher-yielding foreign assets, is showing signs of unwinding. For decades, investors borrowed yen at near-zero interest and reinvested in currencies offering 5 to 10% yields, generating massive profits. However, carry trades only work when the yen stays weak. A sudden rise in yen strength can wipe out profits or create huge losses, forcing traders to unwind positions rapidly. As Japan signals potential changes to long-standing policy, markets may face turbulence across stocks, currencies, and crypto. In the middle of these macroeconomic pressures, XRP's supply shock grows more intense. Exchange balances have fallen from 3.9 billion to 2.6 billion XRP since December, an astonishing 45% drop in only 60 days. This represents the steepest decline in years and arrives exactly when ETF demand begins accelerating. With US credit card debt surpassing $1.23 trillion and global markets showing signs of strain, many investors believe blockchain assets will become essential infrastructure during any financial reset, with XRP positioned as a potential bridge for cross-border settlement and liquidity. Finally, the performance of Bitcoin this December may determine the direction of the entire crypto market. In 3 of the previous 4 years, Bitcoin has finished December in the red. If Bitcoin climbs this month, it could lift the entire market, including XRP. If it falls, most altcoins are likely to follow. But with ETF momentum, tightening supply, private ledger adoption, and expanding real-world utility, many believe XRP enters this period with stronger fundamentals than ever. Thank you for tuning in and staying informed. Your support means everything, and being part of this journey with you is a true privilege. If you found value in the analysis, feel free to like, comment, or share with others who might benefit. The future of digital finance is unfolding right now, and together we'll continue tracking every development that shapes this new era.